Welcome to episode 2 of the ICT Mastery Blueprint, your go-to place to master ICT trading concepts and smart money concepts. This is part 2 of the series. We're going to be talking about inversion fair value gaps. Let's get started. Okay, let's get started with the PDF of inversion fair value gaps. This is a very quick illustration of what an inversion fair value gap looks like, but let's get into the notes. So what is an inversion fair value gap, or IFVG? So in simple terms, an inversion fair value gap refers to a fair value gap, which can be bullish or bearish, that has changed its characteristic from a premium array to a discount array. So if you watched the previous video, we talked about fair value gaps. We talked about bullish fair value gaps, which are discount arrays. And we talked about bearish fair value gaps, which are premium arrays. So when that inverse occurs, that original bullish fair value gap changes its characteristic from a discount array to a premium array. So if you do not already know, a PD array or a premium discount array is a price level or a price range. So for example, a fair value gap range, which is either premium or discount, that is characterized by its repeating price pattern. So PD arrays are referred back to by the algorithm and can be used to navigate order flow. So some examples of PD arrays are fair value gaps, swing highs, swing lows, or in order blocks, etc., etc. Inversion fair value gaps are one of those PD arrays. It's very specific because it is an inversed PD array. So a fair value gap is the original PD array, and an inversion fair value gap can only form if we change the characteristic of a previously existing fair value gap. So this is what it looks like. If you can notice here, first candle high, third candle low, creates this bullish fair value gap. And you can see as we come back and close below it, we have an inversion gap. So this discount array, right, instead of being used as a discount array to move price higher, it's going to be used as a premium array because we inversed it in set narrative. On the other side, we have a bearish fair value gap right here. And you can see this candle right here closes above the fair value gap, which changes its characteristic, makes it an inversed PD array. And instead of being used as a premium array, it can now be referred back to algorithmically to be used as a discount array. So how do you identify an inversion fair value gap? So when we have a bullish fair value gap, when we have a bearish fair value gap, and we have a candle close above this bearish fair value gap, this forms a bullish inversion. So right here, we have a bearish fair value gap, and when we close above it, we have a bullish inversion. In the second example, if you want to annotate a bearish inversion fair value gap, when we have a candle close below a bullish fair value gap, this forms a bearish inversion. So when we have a bullish fair value gap and we close below it, this acts as a bearish inversion, or as we said, a premium fair value gap instead of a discount one. So this is what it looks like. Bullish FVG turns into a bearish inversion. It is depicted by this candle close below the original bullish fair value gap, therefore inversion fair value gap. Over here, candle close above a bearish fair value gap, transform this into a bullish inversion, meaning this bearish fair value gap is now a bullish inversion fair value gap. So why do these inversion fair value gaps form? Inversion fair value gaps form as an algorithmic signature. So when these form, just know that is the algorithm in play. And it helps us understand, it's leaving a footprint for us to understand the order flow and the program that the algorithm is potentially delivering in, meaning a buy or sell program. So using this information, using these inversion fair value gaps when we see them, we can use them to frame trade ideas, trade entries, and also gauge direction and order flow based on the market characteristic, sentiment, and obviously the higher time frame drawn liquidity. So for example, over here we have a bullish fair value gap, and you can see the market comes back, closes below it, changing this fair value gap's character from a discount array to a premium array. Market refers back to it and then trades lower. This is a very typical scenario. You'll see this multiple times. Over here on the bullish case, we have a bearish fair value gap. We see that algorithmic signature, right? That candle close inversing this premium array, turning it into a discount array. The algorithm refers back to it and then propels price higher, changing that, playing out that narrative. So Let's talk quickly about high versus low probability inversion fair value gap. So these are the characteristics for a high probability one. A low probability one would just be not having some of these. So first things first, it forms off of a key level. So when you see that change in characteristic of a fair value gap from a key level, that's a very high probability inversion fair value gap. If it forms with displacement, now, like I said in the previous video, the actual size of the gap does not matter. It is still an algorithmic signature. What matters is the displacement away from that key level. That's what indicates the strength and the sponsorship, I guess you could say, in that potential move that's going to happen. If this inversion fair value gap forms after opposing liquidity is taken, that will make the trade higher probability, that rate on liquidity, so then we can then distribute the positions that were accumulated. If it forms in confluence with other levels, this is a mistypo, let's just say other, not order. So with other levels, so for example, if you have an inversion fair value gap that aligns with, let's say, a bearish fair value gap or a breaker block, that is a high probability, that is a more high probability inversion fair value gap. And of course, the final and most important one, in my opinion, if it forms in the direction of the drawn liquidity. So if you have a certain level higher that is likely to be met, and you see a bullish inversion, that bullish inversion is simply higher probability. So this is a plus textbook example. Over here, we have a key level. Market trades down and then up into that key level. We have a liquidity sweep. We have a nice rejection wick. We have this bullish fair value gap. Now, because we know where the market is drawn to, so this drawn liquidity, we're not looking at this as a discount array. We're waiting for it to change characteristic. Over here, we have a nice displacement closing below, creating this bearish inversion. Market trades back into it and then propels towards the drawn liquidity. On the other side, we have a key level. Price trades up and then down into that key level. We have a liquidity sweep from this previous low, rejection wick off that key level. We have a bearish fair value gap, and instead of using that as a premium array to send price lower, we actually wait for the characteristic to change. And once we see that change in characteristic, you see that close right there with the displacement. Market refers back to it as a bullish inversion and sells in price higher towards the drawn liquidity. So that is a pretty brief summary about inversion fair value gaps. Let's get to the charts and I'll give you some live examples of trade ideas, how to gauge order flow, how to predict where the market's going to go, etc., etc. Okay, so for our first example, we're going to talk about a high probability inversion fair value gap. This is NASDAQ on the daily chart. And as you can see here, we have a liquidity sweep. So liquidity has been taken out of the marketplace right here. And like we said in the video earlier, instead of looking at this gap as an discount array, so as a bullish fair value gap, we can actually wait for a more higher probability scenario, which is wait for the gap to get inversed, which is right here. So it changes characteristic. And you can see how the market performs this inversion fair value gap. So it leaves this inversion fair value gap. After taking liquidity, we have very solid displacement. And you can see the next couple of days trade lower towards the drawn liquidity. So if you were in the live streams this week, you would have seen we did primarily take a lot of winning trades that were short. And this kind of framed the idea for a bearish bias going into the rest of the week. And you can see that very aggressive displacement towards that drawn liquidity that we had outlined on the live stream. So this is one example of how you can use just the inversion fair value gap in a high probability narrative to find bias and gauge order flow. So here is another example where you can use a inversion fair value gap, this time potentially for a trade idea. So you can see the market engineers these relative equal highs, as well as we have a resting buy side liquidity resting right above here, and also this higher time frame relative equal high. So knowing we have a potential drawn liquidity higher, we can come back into a discount and see what is going on in this price range. So price comes back, trades into this bullish fair value gap. Again, if you haven't watched the first episode, that may sound a little bit confusing, but the market trades back down. And notice we didn't really take out any liquidity on this move down. So this is not a high probability move lower. In fact, we actually want to find support at this level to trade higher. So what are we looking for? So as the market comes down, we trade into this bullish fair value gap. And if you were to wait and notice on the left, we have a bearish fair value gap right here. And once the market inverses that fair value gap, we trade back down into it, and then we start to expand higher. If you notice again to the left, we have another inversion fair value gap right here. So this candle right here displaces through, closes above, we trade back into it, and then trade higher. We take out this high, and then eventually we take out those relative equal highs as a buy side liquidity objective. So you can see how you can use this inversion fair value gap idea as a trade entry mechanism if you have the correct drawn liquidity and you have the confluences looking for a high probability setup and a high probability inversion fair value gap. All right, now I'm going to give you guys a combination of fair value gaps and inversion fair value gaps to see a full outlook and interpretation of how you can use these gaps to get bias, gauge order flow, and take a trade entry. So in the power of hindsight, we can mark out this bearish fair value gap resting in premium. Why is this one important? Because like I said, this is a fair value gap that is resting in premium of the range. Obviously, you have this little fair value gap right here and this one as well. So coming back into discount of the range, you can see liquidity has been taken out of the marketplace. We expanded higher, we retraced, and we're looking for this premium objective. So what do we see here? As the market retraces, we put inside this bearish fair value gap right here. So originally this is a bearish fair value gap. However, if you were to wait a little bit, you can see we changed the characteristic of this fair value gap into an inversion fair value gap. And in doing so, we actually placed a bullish fair value gap resting right at this level. Now I'm going to tell you guys something that we did not discuss in the first video because this is a little bit more complex of an idea. So if you can look very closely into this fair value gap, you can actually see that there is a volume imbalance between these two bodies. So studying this price action closely, there is a gap between the two bodies of this bullish fair value gap. So when you're annotating your bullish fair value gap, you have to include the gap in between the bodies. And that would go for the same on this side. So over here, we have a gap between the bodies. So you would actually drag your box and make sure you include that because you'll see the signature in price where if we're really bullish, we're not even going to trade into the fair value gap completely. We're just going to trade into the upper portion. And if you're going to include this in the upper portion, you have to make sure you include that volume imbalance. So if you were to do it just like this, you would be incorrectly annotating that fair value gap and you would not be annotating it correctly. So if you actually look again, understanding that concept, you can see we actually have that volume imbalance on that first example that we talked about. But now that we know how to correctly annotate our gaps, you can see after this inversion fair value gap right here, the market trades back down into it once, twice, and then moves higher. So let's go zoom into this price action and see if we can find a trade entry using this higher time frame inversion. So let's go down to the 1 minute time frame and see what happens. So as you can see right here, there is no inversion fair value gap in this price range. We also did not take out any liquidity as we came down. So as we know, a high probability inversion fair value gap occurs after liquidity is taken. So if you wait for your liquidity sweep, which is right here, trading into that higher time frame inversion, and then you wait for an inversion fair value gap on the lower time frame, you can see right here on this candle at 1540, we have the inversion. Market refers back to it once, twice, 3 times, 4 times before sending price higher towards that higher time frame objective. This trade also occurs inside of a macro, so that is another probability, a higher probability confluence for this trade to play out. But hopefully you can see how we can use an inversion fair value gap on the higher time frame, and then zooming into the lower time frame as the market trades back into it. Simply using inversion fair value gaps alone, we can find high probability trade setups as long as you're using those trade criteria and you have the correct drawn liquidity in your trade narrative, as well as those confluence levels for high probability gaps, bullish and bearish. So with that being said, that is everything I wanted to cover in this video about inversion fair value gaps. If you have any questions, feel free to leave a comment in the description below or in the comment section below. I also have a free Discord if you want to come through. The link should be in the bio, in the description as well, and in my About Me page on YouTube. So if you wanted to join that, it's completely free. Feel free to come and ask any questions. I will see you guys for episode 3. Take care.